Most traders approach breakouts like treasure hunters spotting gold in a riverbed. But what glints before them is fool's gold carefully planted by those who understand the river's true currents. The conventional wisdom whispers that when price finally breaks above obvious resistance or crashes through well-tested support, the floodgates have opened and profits await those brave enough to follow momentum. This belief has filled more trading account graveyards than any other misconception, because it fundamentally misunderstands the chess game being played at institutional levels. Richard Wyckoff spent decades observing how the composite man operates, and his most crucial insight reveals that what appears to be the beginning of a major move is actually the final act of an elaborate trap designed to separate amateur traders from their capital. The first clean break above resistance isn't smart money rushing to buy. It is smart money creating the illusion of strength to attract final buyers before beginning their distribution campaign. Similarly, that decisive break below support isn't institutional panic selling. It is a carefully orchestrated probe testing how much genuine selling pressure remains before they commit serious capital to the long side. These false breakouts aren't random market noise. They're as predictable as sunrise once you understand the underlying mechanics of accumulation and distribution. Before committing substantial capital to significant price movements, smart money must first ensure the path is clear, systematically absorbing available supply during accumulation or distributing desired inventory during distribution. This critical clearing process manifests as what retail traders mistakenly identify as breakouts. False moves designed to entice early entries, trigger stop losses, and create necessary counterparty liquidity for institutional positioning. The volume signatures during these moves tell the real story, but most traders are too busy calculating position sizes to notice that massive effort produces minimal result, or that price moves effortlessly in directions requiring substantial institutional participation. Every successful Wyckoff student learns to read these volume price relationships like a detective examining fingerprints, because evidence of manipulation is always present for those who know where to look. The psychological beauty of these traps lies in exploiting our deepest trading fears and desires simultaneously. Fear of missing the big move and desire to be right about our analysis. When that breakout finally happens after weeks of consolidation, every fiber of our pattern recognition brain screams, "This is the moment we've been waiting for." But Wyckoff taught us that when something appears obvious to everyone, it is usually the moment when everyone is about to be wrong together. Comment trapped. If you've ever been caught by a false breakout that seemed absolutely certain, understanding why these traps are inevitable rather than accidental requires diving deep into the laws governing all market behavior, laws smart money uses as tools while retail traders remain blind to their existence. Having established that breakouts often deceive rather than deliver, we must examine the analytical framework that separates genuine moves from sophisticated traps, Wyckoff's law of effort versus result, the foundation upon which all professional market reading rests. This law operates with mathematical precision, stating that when volume effort aligns proportionally with price result, the move reflects natural market forces. But when effort and result diverge significantly, manipulation becomes not only possible, but probable. Effort represents the energy expended to move price. Volume spread, volatility, the urgency visible in order flow. Result captures the actual progress achieved, net price distance, quality of closes, ability to hold gains or sustain declines. When effort expands while result contracts, you witness absorption during accumulation or distribution during topping processes, where institutions systematically work large orders without revealing directional intent. When effort diminishes while result improves, the path of least resistance has been cleared through prior smart money positioning. Consider the apparent breakout that surges on massive volume yet closes back inside the range with long shadows, tremendous effort producing poor result, textbook distribution into eager buyers. Contrast this with a spring that dips below support on moderate volume, snaps back decisively, then advances on lighter effort with superior spread, modest effort achieving outsized result. Evidence that supply has been nearly exhausted. Wyckoff taught that professionals do not merely react to existing supply and demand, they actively create imbalances, then observe market response through these effort-result dynamics. They engineer situations where high effort yields poor results to exhaust opposing forces, or where minimal effort produces strong results once resistance has been systematically removed. During accumulation campaigns, smart money creates apparent weakness through increased selling effort that produces disproportionately small declines, absorbing natural supply while discouraging retail participation through boring sideways action. During distribution phases, they manufacture apparent strength through buying effort that generates impressive advances, attracting retail enthusiasm, while transferring inventory to willing buyers. The tape becomes a balance sheet where volume records the attempt and price records the accomplishment. 3 diagnostic questions clarify any situation. Was the last push fueled by abnormal effort? Did it achieve proportionate result? Do subsequent tests show diminishing effort against strengthening result? Alignment of these factors positions you with the composite man rather than against institutional flow. This law provides universal application across all markets and timeframes because underlying supply-demand dynamics remain constant regardless of specific instruments traded. Professional edge emerges from recognizing when current effort-result relationships deviate from recent norms within identical market structures, signaling changing control between amateur and professional participants. Understanding this foundational law transforms chaotic price action into readable institutional behavior. But translating knowledge into profitable decisions requires examining the specific architectural phases through which smart money systematically builds positions before executing their most effective traps. With the law of effort versus result providing our analytical foundation, we can now examine the systematic architecture through which smart money constructs their most effective traps within accumulation ranges. A process so methodical that Wyckoff identified 4 distinct phases, each serving specific institutional objectives while maintaining market appearances that discourage retail participation. Phase A marks the stopping action where sustained selling pressure finally encounters sufficient buying interest to halt the decline, typically displaying climactic selling on high volume followed by automatic rallies as selling pressure temporarily exhausts itself, establishing the preliminary boundaries of what will become the accumulation range. This phase neutralizes the existing downtrend through initial smart money intervention, creating the first evidence that institutional buyers have begun absorbing supply at attractive levels, though the market still appears weak to casual observers. Phase B represents the cause. Building period where the real accumulation work occurs through systematic absorption of available supply while maintaining range. Bound price action that appears deliberately boring to retail participants. During this extended phase, smart money methodically works large orders across multiple time periods, creating the cause that will eventually justify substantial markup once accumulation completes, and the tape reveals this activity through volume signatures that show persistent effort with contained results. As institutional buying absorbs natural selling without allowing significant upward progress that might attract unwanted retail attention. The psychological brilliance lies in making professional accumulation appear uninteresting through sideways grinding that tests retail patience while providing optimal entry conditions for those who understand the underlying process. Phase C contains the critical test that serves multiple functions simultaneously, clearing remaining weak holders, testing supply availability at lower levels, and creating the final trap that will shake out impatient traders before markup begins. This phase often manifests as a spring where price appears to break decisively below the accumulation range, triggering panic selling and stop-loss orders, only to reverse sharply as smart money demonstrates their accumulated position strength through decisive buying that overwhelms the manufactured selling pressure. Phase D reveals preliminary signs of strength as available supply becomes increasingly scarce and smart money begins allowing price to reflect their accumulated position through improved effort-result relationships, with expanding spreads on reduced volume providing evidence that natural selling has been largely absorbed and the path upward offers diminishing resistance. Recognition of these phases transforms apparently random consolidation into readable institutional behavior. But maximum deception occurs during the spring test when apparent breakdown becomes the strongest signal that accumulation has reached completion, requiring precise understanding of how these final examinations operate to separate genuine breakdowns from manufactured traps, designed to harvest the last available liquidity before markup begins. The moment of maximum deception arrives when the composite man administers his final examination through the spring in accumulation and the upthrust after distribution. Sophisticated probes designed to test remaining supply, and demand one last time before committing substantial capital to major directional moves. A spring appears to definitively break support with authority, often accompanied by increased volume that suggests genuine institutional selling, triggering cascading stop losses and panic selling from trapped longs who interpret the move as resumption of the prior downtrend. Yet, this apparent weakness represents calculated manipulation where smart money allows price to penetrate just far enough to harvest remaining supply before demonstrating their accumulated strength through decisive reversal buying that overwhelms the manufactured selling pressure. The volume signature reveals the deception through classic effort, result divergence. Climactic selling effort produces minimal downside progress, followed by superior upward result with reduced buying effort as the path of least resistance shifts dramatically once available supply has been tested and found exhausted. The upthrust operates through mirror mechanics but identical psychology, seemingly breaking resistance with conviction to attract final buyers who interpret the advance as confirmation of bullish momentum, only to reverse sharply as smart money distributes remaining inventory to these eager participants while volume analysis reveals that apparent buying strength was actually distribution masquerading as accumulation. 3 categories of tests provide operational recognition frameworks. Type 1 springs and upthrusts display immediate rejection through wide-range reversal bars that close opposite to the break direction on climactic volume. Type 2 tests manifest as quieter probes with narrower spreads requiring subtle effort, result analysis. And Type 3 scenarios involve no obvious retest where lower timeframe examination becomes crucial for identifying completion signals without structural penetration. The danger point emerges naturally from this analysis, representing the specific level where structural invalidation occurs if violated after the test, allowing precise risk definition that aligns with institutional behavior rather than arbitrary percentage-based stops. Typically positioned just beyond the spring low or upthrust high to capture the failure of the failure while maintaining favorable risk-reward ratios. Professional position sizing methodology flows directly from these structural levels, seeking minimum 3-to-1 reward opportunities based on measured objectives derived from the cause built during accumulation or distribution phases, with range dimensions providing mathematical frameworks for profit expectations that reflect institutional positioning rather than hopeful projections. Recognition requires demanding evidence before commitment. After springs, up bars should lengthen while down bars shorten, with closes migrating toward upper portions of ranges. While after upthrusts, the inverse signatures should appear as selling pressure reasserts control and buying enthusiasm wanes under institutional distribution. These final examinations transform apparent market failure into the strongest possible signal of impending directional success. But understanding mechanical recognition represents only half the equation, because the devastating effectiveness of these traps relies fundamentally on exploiting predictable human emotions that even mechanically sophisticated traders struggle to overcome when capital and ego converge at moments of maximum uncertainty. The devastating effectiveness of Wyckoff's traps stems not from their mechanical complexity but from their surgical exploitation of predictable human emotions, a psychological warfare where the composite man systematically harvests fear, hope, and ego with the precision of a master surgeon operating on willing patients. 3 archetypal personas emerge from every trap, each representing emotional responses that smart money counts on and systematically exploits through carefully engineered market behavior. The chaser sees price break through obvious resistance, feels the primal urgency of missing the next exponential move, and buys the upthrust at precisely the moment distribution requires eager counterparty liquidity. Interpreting apparent institutional strength as confirmation of analytical brilliance while unknowingly funding smart money's exit strategy, the defender watches a spring violate support, refuses to accept the danger point has been crossed, and moves protective stops away from structural invalidation because admitting error feels more painful than accepting larger losses, converting controlled risk into devastating account damage through stubborn position defense. The hoper clings to losing positions as mounting evidence contradicts their thesis, confusing apparent confirmation with genuine institutional sponsorship, mistaking large volume moves for smart money participation when effort-result relationships plainly reveal distribution or absorption activities. Each archetype is animated by the same psychological triad that the composite man exploits with mathematical certainty: fear of missing opportunity, aversion to admitting error, and egoic need to be right about market predictions rather than profitable about market realities. Hope becomes most dangerous when supported by apparent confirmation, such as upthrusts displaying surface characteristics of genuine buying strength, encouraging retail expansion precisely when smart money begins serious distribution to these willing participants. Fear proves most costly when it drives capitulation at exactly the moment smart money completes accumulation through springs that appear to confirm worst case scenarios amateur traders have dreaded throughout consolidation periods. Wyckoff understood that ego fuels every trap because traders who cannot admit small errors inevitably suffer large consequences, and the composite man engineers situations where being right initially feels more important than being profitable ultimately. The semantic twist that separates professionals from amateurs reveals itself through reframing apparent failure as necessary education. Being stopped out at a spring and re-entering on successful test isn't weakness or indecision but professional behavior aligning with smart money operations rather than fighting institutional flow through emotional stubbornness. Pre-commitment protocols provide emotional insurance against these predictable psychological failures through writing invalidation prices before entry, rehearsing loss scenarios to reduce emotional impact during execution, and accepting re-entry costs as professional overhead rather than personal failure reflecting analytical inadequacy. Wyckoff's moral framework emerges clearly through this lens. Hope without discipline destroys more accounts than fear without knowledge, because hope encourages position expansion at precisely wrong moments, while fear promotes survival through defensive behavior. Comment: disciplined. If this psychological reframing resonates because understanding these emotional dynamics completes our educational foundation, requiring only systematic integration of mechanical recognition with psychological discipline to transform knowledge into consistent profitability. The synthesis of mechanical recognition, psychological awareness, and disciplined execution crystallizes into a coherent trading philosophy that aligns with smart money operations rather than fighting institutional flow through emotional reactions to obvious patterns. True edge emerges not from predicting every market movement but from recognizing when probability overwhelmingly favors specific outcomes. Namely, when apparent breakouts reveal themselves as tests designed to fail and reverse, presenting high probability entries for those who understand institutional positioning. The operational framework distills complex Wyckoff principles into actionable steps. Identify accumulation or distribution ranges through volume, price analysis. Expect probes at structural boundaries as natural institutional behavior. Demand volume confirmation that tests have failed through effort-result divergence. Then act decisively when reversal signatures align with smart money rather than amateur emotional responses. Professional traders buy when selling pressure is tested at springs and found absent, sell when buying pressure is probed through upthrusts and proves inadequate, understanding that patience represents an active position costing nothing while maintaining optionality for high probability setups that amateur traders miss through premature commitment to obvious breakouts. Execution becomes systematic when anchored by principle. Size positions so invalidation sits just beyond spring lows or upthrust highs. Demand minimum 3-to-1 risk. Reward ratios measured from accumulated cause, and accept being stopped out quickly as professional rent rather than personal failure. Because the composite man charges tuition to those who argue with the tape rather than reading it objectively. Wyckoff's deepest wisdom transcends mechanical recognition, emphasizing that discipline trumps prediction because markets reward process consistency over analytical brilliance. That logic must govern impulse because emotional decisions align with retail behavior, and that humility enables profitable adaptation while ego creates rigidity that smart money systematically exploits through predictable psychological manipulation. Practical mastery requires systematic documentation, screenshot suspected traps before resolution, annotate effort, result relationships during real-time analysis, track emotional states during decision-making, and review outcomes to identify recurring patterns that undermine mechanical understanding through predictable responses. Comment aligned. If this framework resonates, then commit to structured practice through weekly chart reviews where you identify 3 potential setups, mark danger points before price reaches them, and rehearse position sizing calculations until execution feels routine rather than emotional. The moral insight reveals trading as character development disguised as financial endeavor. where consistent profitability emerges from internal discipline more than analytical sophistication, requiring ongoing development of humility to admit errors quickly, courage to act against obvious appearances when evidence supports contrarian positioning, and patience to wait for structural confirmation rather than forcing trades that satisfy psychological needs for action. This foundation prepares you for advanced Wyckoff applications, including precise cause measurement for effect estimation and recognition of absorption patterns within trending markets, where institutional behavior becomes visible through systematic analysis rather than hopeful interpretation of obvious surface patterns.